All right, let's go ahead and take a look at some couple of different little matching exercises that hopefully will help us understand some of the concepts related to the FIFO, Lifo, and weighted average cost flow methods, okay, or cost flow assumptions rather. All right, so here we have choice A, B, and C are those three cost flow assumptions, and we're just going to match the description here to one of these three letters. I did mark out a couple of these because I thought that the explanation that I would give you for an introductory level accounting class was quite honestly not worth the time, and it might confuse you. So this first one here, it says produces the same cost of goods sold under both the periodic and the perpetual inventory systems. Okay, so if we think about these, we had an exercise that we did in one of the other videos that kind of showed this, but our answer here is going to be FIFO. And I want to just spend a moment on this just to kind of tell you why. When we use the perpetual inventory system with FIFO, we start off with our beginning inventory, and we're always pulling from the oldest material, the oldest inventory. We're always going to do that. So if we were to make a large purchase, say in the month of February, and I mean like a really large purchase in the month of February, we would still, say in the month of May or June, if we still had inventory left over from that purchase in terms of quantity, maybe we got a really good deal on the inventory, something like that, we would still go ahead and pull from that, even if we had made some other more recent purchases, right? Because it's first in, first out. And that's what would happen under a perpetual inventory system using FIFO. And of course, with periodic, we're just going to go and say, okay, that we sold 1,500 items over the course of the year, whatever the quantity is. And then we're just going to go to our beginning inventory, and we're going to cost from beginning inventory, and then we're just going to go in order of all of our purchases. But of course, now with weighted average, it's a kind of a complicated mess using a perpetual inventory system, but it can definitely be done with computer software. But with weighted average, we normally are going to just be focusing on periodic only, so we're going to X that out as a possibility. And then, of course, if you think about LIFO, well, with a periodic system, we would just get to the end of the year, and we would kind of go backwards from our most recent purchases on back. That's what we would do with a periodic system using LIFO. But if we were using a perpetual system, we would cost that inventory as we go from whatever was the most recent purchase at that time. So FIFO is the only one of these cost flow assumptions that will produce the same cost of goods sold under both a periodic and a perpetual inventory system. All right. This next one, I believe, is also somewhat tricky. It says widely used for tax purposes. I'm going to give you the answer. It's LIFO, and then I want to explain to you why that is, because there's a bit of an assumption that we're making here when we say that it is widely used for tax purposes. Okay, and the assumption is that inventory prices tend to go up. All right, and so if that's the case, if inventory prices do tend to go up and we use LIFO for tax purposes, what happens to our net income? If cost of goods sold is going up, if cost of goods sold is going up, net income is going to go down because our gross profit's going to be less. and then it's going to trickle all the way down to net income. And so we're going to be paying our income tax based, for our purposes, on net income. Now, I realize this is not a tax class, but if we think about that, we all know that we pay income taxes on our earnings, whether we have a job or whether we own a business. So on the assumption that prices tend to increase over time rather than decrease, Lifo would be advantageous for the most part for income tax purposes. Never results in either the highest or lowest possible net income. This is our good buddy, the weighted average. And we said in the chapter that it will result in net income that is in between Lifo and FIFO, cost of goods sold, ending inventory. All of these items will be in the middle between FIFO and Lifo, assuming, of course, that prices have changed throughout the year. Okay? All right. It says produces the highest gross profit when costs are decreasing. All right. So now I want to jump back up real quick to this one, and we said that this is using Lifo for tax purposes is based on the assumption that inventory prices tend to go up. So we need to recognize that this situation right here is the opposite of this assumption here. Let's read it again. Produces the highest gross profit when costs are decreasing. Okay, so if this is our scenario and we were to use Lifo, we're actually going to end up paying more in income tax because we are costing those most recent inventory costs in a decreasing environment. So in this situation, using Lifo, we would have higher profits. Because let's say that we were paying $5 per unit and now we're paying $4, and let's say we're selling the item for $10. Well, let's think about it. Before, in this particular environment, we've always paid $5, now we're paying $4. Well, under FIFO, our gross profit per item anyway would be $5. But under Lifo, it would be $6 because we're always going to expense the most recent inventory costs. So this is counter to what we normally see with inventory pricing. But this can definitely happen, especially when we have a product, and a type of inventory that is really, really popular, and then it becomes obsolete, something like that. But there's still a lot of demand for it. We still might order it, but the prices might start decreasing that we pay at that point. All right, produces the highest ending inventory when costs are increasing. Okay, so if costs are increasing, to produce the highest dollar value of ending inventory means those most recent inventory purchases are remaining in ending inventory. So what's being costed? The oldest inventory, and that is the textbook definition of FIFO. Okay. All right. Assigns the same value to all inventory units. This is, I'm just going to give you the answer and then I'll spend a little bit of time on this. This is your weighted average. And I can guarantee you that this choice was written thinking about a periodic inventory system. But if we think about it, even if we were using a perpetual inventory system, this would be true. Because, you know, if we paid $9 for one item and then $11 for the second item, well, now we're saying both items have a value of $10, right? Even if we purchase those items at different times, and we almost certainly would have purchased them at different times. So assigns the same value to all inventory units weighted average. Next one, prohibited under international financial reporting standards. This is something that if you were studying for the CPA exam, you would actually need to know. For our purposes, really not that important, but the answer is Lifo. Lifo is not prohibited under IFRS. And just so that you do know, even though we teach this class from the perspective of U.S. GAAP, most countries in the world do not use U.S. GAAP, of course, right? They use IFRS, so is an important distinction. All right, does not follow the physical flow of goods in most cases. All right, this is also going to be Lifo, and the reality is that none of these cost flow assumptions necessarily follow the physical flow of goods, right? But a lot of times in a grocery store, that's the best example that I can give you. Grocery stores and grocery store chains are always going to use FIFO because, you know, they have a lot of perishable items, and they will at least attempt to sell the oldest goods first. In fact, in some countries like New Zealand, they literally break the grocery store. There are actually two stores within a store. You have the very small area that customers shop in, and then there's this whole other area that you never see as a customer where they have the inventory ordered in terms of age, and then they bring it out only as needed. Of course, their stores there are a little bit smaller, at least the part for the customer. Okay. So FIFO does a better job of following the physical flow. There are a few examples where Lifo does, but very few. Very, very few. I gave you the example, I think, in one of the lectures of the bins with the nuts and bolts at the hardware store. They just pour them all into this big bin, and then you go and you take what you want. That, if you were using Lifo for your selling of your nuts and bolts, it actually would follow. But for the most, Lifo does not. Okay, moving on. Cost of the latest purchases are assigned to ending inventory. Well, let's think about this. If we're using FIFO, we are expensing the oldest purchases. That means the latest purchases, the most recent purchases, are in ending inventory. All right, let's go ahead and end this video, and we'll do the second set of matching exercises in another video.